So let's talk about relative strength and that 212-degree difference that we discovered on the intro video. So as you noticed, at 211 degrees, water's hot, but it's still standing still and it's not really doing much, kind of like a lot of stocks before they start to take off. And as that temperature rises 1 degree, water starts to boil, creating steam that can power a locomotive train. So it's this extra 1 degree that can really make all the difference. And it's like when a stock starts to outperform a major benchmark index or sector and then skyrockets. It just takes that one little extra degree to push it over the edge and get it moving. So keep that theme in mind as we get into the fun stuff here. Now, there's a number of ways to gauge strength of an asset, whether it's a stock or an ETF or a futures contract, whatever you're trading. There's some degree of relative strength involved with that security. And most traders or investors use what's called the relative strength index, or the RSI. This is kind of the standard indicator that is used in the industry to gauge the strength of an asset. And I can certainly tell you that a lot of my hedge fund colleagues and professional money managers actually use this indicator. It's very widely used in the professional trading and investing world. And so we're going to start out by looking at the RSI and talk a little bit about what it is, and also what actually some of the drawbacks to the RSI are. So if you're not familiar, the relative strength index, or the RSI, is a momentum indicator. And it's typically used in technical analysis to help us measure the magnitude of recent changes in a stock's price. So it basically is developed or designed to evaluate overbought or oversold conditions. And it's displayed as an oscillator. So when you add the RSI to your charting platform, it's going to show up as a line graph that moves between two extremes. And it is a bounded indicator, what's called a bounded indicator. So it does have a maximum that it can move up or down. And so it's bounded to the downside and to the upside. And it can have a reading from anywhere between 0 and 100. Now, this indicator has been around for a long time. It was originally developed by J. Wells Wilder and introduced in his book back in 1978, New Concepts in Technical Trading Systems. And so it's been around for quite some time. It stood the test of time, and now it's really widely used, again, both among retail traders and professional investors and traders. So if we look at the traditional interpretation and usage of the RSI in terms of how we would use it to evaluate whether an asset is overbought or oversold, typically a value over 70 would indicate that the securities become overbought or overvalued. And a lot of people will consider that an opportunity to either exit a long trade or look for a short opportunity, because it may tell us that the security is primed for a trend reversal or correction. Now, an RSI reading of 30 or below indicates an oversold or undervalued condition. And so that's typically how it's used. There are, like most indicators, a lot of different ways to interpret and use the RSI, but that's typically the most standard accepted way to use it as an overbought, oversold oscillator. Now, as I mentioned, there's a number of problems with the traditional RSI. Here's problem number one. Stocks can remain overbought or oversold for very extended periods of time. And if you've ever used the RSI, I would be surprised if you haven't noticed this occur. And it's actually that old John Maynard Keynes saying that the markets can remain irrational longer than you can remain solvent. And that really is the truth for all of us. Even some of the larger funds out there can run into trouble when they are speculating on a trend reversal. And that certainly happened a lot last year. I know a number of my hedge fund colleagues were completely wiped out due to margin calls in the Corona crash of February, March, and into April last year. So this can really be an important factor to consider when looking at using a relative strength indicator. And so let's kind of look at an example of that on what I mean by that on the chart. This is a daily chart of Tesla, and Tesla's really been a hot stock lately. It's really made some big moves recently. And you'll notice that I've got the RSI indicator plotted at the bottom of the chart here. And you'll see here that the overbought, oversold levels are marked. So 30 being oversold and 70 being overbought. Now remember, this indicator can't go above 100 and can't go below 30. So you'll see here that in October, something interesting happens. The RSI goes above 70. So based on the interpretation or this traditional interpretation of the RSI, it's telling us Tesla is overbought. This is not necessarily a great time to be entering shares of the stock or buying the stock, right? But what happens shortly after is the RSI continues to print readings above the overbought level of 70, is the stock takes off. So unfortunately, the RSI gave us misleading information, told us that Tesla was in overbought territory, even though the stock continued to go up, and not just go up, but you can see it went up a lot, right? So this would not have been very trustworthy information from the relative strength index. Here's another example. This is Best Buy, ticker BBY, another daily chart here. So we've got the RSI, and you'll notice that the RSI was kind of in that overbought territory for a good number of months. In May, it was just bumping right up against that 70 overbought level, and then finally broke through it in late July and stayed above 70 for well over a month. But what happened to the stock? It actually took off. So it was kind of ranging between 70, 75, 80, and then takes off and goes up to over $100 a share in a matter of months, all while the RSI was telling us that it was overbought and we shouldn't be getting into the stock. So again, it misled us. Here's another example. This is Amazon, AMZN. Now, this is a daily chart as well. And if we look at the time period of the RSI here, starting in June and going into July, what's happening? It's telling us again that Amazon is overbought, and most likely due for a trend reversal or a pullback. But instead, the stock takes off. And interestingly, the oscillator never did tell us that Amazon was oversold and give us really any good indicator of an opportunity to jump into the stock if we wanted to buy shares of Amazon. Instead, the stock just takes off. And when the RSI reading was overbought in June, the stock was trading around $2,700 a share. Look what happens by late August. It's up over $3,500 a share. That's a huge move to the upside that we would have missed out on if we trusted the traditional relative strength index. So you can see that there are some drawbacks to using the RSI. And again, problem number one that I really want you guys to notice from these charts is that even though the indicator tells us that the stock's overbought, and it may very well be, it can stay overbought for really as long as it wants to. As long as people want to jump into the stock and create demand or buying pressure, the shares are going to keep going up, right? So we're going to be looking tonight at a twist on the traditional RSI that, as you'll see here shortly, does a much better job at telling us based on relative strength whether a stock is going to go up or down. And by the way, you can use this for any asset class. You can use it for stocks, ETFs, futures, Forex, anything that trades. This can be applied to, and I'll show you kind of how that works, as well as any time frame. So this is really a universal principle. It doesn't matter whether you're trading a short time frame or an intraday 1 minute, 5 minute, 10-minute chart or a daily chart. The same principle applies. So what we're going to look at as far as a twist on the traditional RSI is a unique way to use relative strength to gauge the whether a stock's likely to go up or down. And so if you'll notice here, using this new formula that I'm going to share with you guys tonight, we've got a green histogram, and it's telling us that this stock is outperforming what I'll reveal to you here in just a second on a relative basis. And you'll notice what's happening to the share price of Amazon. It's going up. And then you'll notice that when the histogram turns red, that means the stock is starting to underperform on a relative basis. So you'll see that there at the bottom of the screen. And what happens to the shares of the stock? They go into a sideways ranging channel. So this might not be the best time to go long the stock or enter any sort of a bullish strategy, even if you're using options. This tells us that the stock is less likely to make a significant move up or go into an uptrend. All right, so pretty cool, right? This looks a lot easier and more effective than the traditional RSI. Now here's problem number 2 when we look at the traditional RSI indicator. It only measures the current strength of the stock relative to its past price. So I'm going to say that again because it's important. It only measures the current strength of a stock relative to its past price. So it's basically telling us the strength of the stock relative to what the strength of the stock was in the past. And you can, for those of you who can kind of read into that or think a little bit deeper into what that means, is it's basically telling us that the stock is performing very strongly based on the past price. Well, of course it's going to if it starts to go up, but then inevitably what happens is when the RSI goes above the overbought reading of 70, the stock's still going to be going up, right? And if it is, the RSI is going to give us misinformation. So you can see what kind of problem that creates. Now here's the good news. There's a solution. Wouldn't it make more sense to identify a top performing index or sector and select a stock that is outperforming it? So rather than compare the performance or the strength of a stock to itself, why not compare it to its index or its sector that is already performing well? Do you see what kind of edge that could give you? If we can identify an index or an industry or a sector that's already performing well, and I'm going to show you how to do that here in a second, then wouldn't it make more sense to then start looking for opportunities within that industry or sector and then find the one that's outperforming it? That's going to give you that extra 1 degree edge that will help you spot these opportunities before stocks skyrocket. And that extra 1 degree difference can take a losing system and give it the steam that can spot the next stock that is ready to explode. And guys, you can apply this information to any system or strategy you're already using. So whether you're using any sort of other momentum indicator or trend following system or whatever, if you use this relative strength information, it can give you the extra edge to help you stay out of stocks that are not performing well or underperforming. So this 1 degree difference can make a really big, have really big positive results to your bottom line, because often when a stock begins to outperform a major index or an industry or a sector, it goes on to make a big move up. And we're going to look at some more case studies of that. But the key is to identify stocks that shift from underperforming to outperforming relative to a benchmark index or sector. Okay, that's important. And then once we identify that, these opportunities can really be the golden ticket to beating the market. So, you may have heard the statistic that fewer than 1% of professional money managers can actually beat the S&P 500 index. But you'll see when I reveal this secret to you, how really it is very possible. And you don't have to be a professional hedge fund manager or a money manager to accomplish that. So what I'm going to share with you guys tonight is actually going to give you and arm you with the tools, tips, and tricks you need to be able to beat some of the pros out there. And it is possible. And I really love this saying. Jim Cramer's a pretty wild guy. I'm not really a avid viewer of Mad Money, but I do like his saying, there's always a bull market somewhere. It's really couldn't be more true. And when we're in a market correction or a bear market, that's a lot of times our members will ask, well, what do we do when we're in a correction or even in a full bear market? Well, the nice thing is if we're using relative strength, it can help us identify opportunities that outperform the broader market. So we can even do well in bear markets. And even in the worst market conditions, as Jim Cramer points out, there's always stocks that are going up. And relative strength is really what can help you find these opportunities, as you'll see here in a second. And I'm going to give you my 4-step process to help you guys do this. So let's go back to that chart of Tesla, ticker TSLA. All right, this is the same chart we looked at earlier, but now I've got a little twist on the RSI plotted on our chart. So I kept the RSI up as well, so you can see where it told us not to get into the stock and told us that it was overbought. I've seen a couple people put some divergent things about divergence in here as it relates to the RSI, and that can sometimes be valuable. Divergence is very difficult to trade because it doesn't actually tell us exactly when to get in or when the divergence is going to reverse. So divergence, while it can tell us good information, it's much easier to spot in hindsight than actually trade in live conditions. So for that reason, I don't particularly like divergence trading, but I'm going to show you a much easier way. So what we've done here is we've added an indicator that is looking at the relative strength of Tesla versus the S&P 500. Now, why the S&P 500? Well, at this particular time, this was in 2019, the stock market on a whole, as well as the S&P 500 index, was performing very strongly. So we know that the broader market in the S&P 500 is going up. So wouldn't it make more sense to find stocks that are outperforming something that is already performing very well? Because if we just use the RSI, it's not going to tell us that, right? So look again, in October, November, December, the RSI told us Tesla was overbought. But look what happened here towards the end of September. Well, prior to that, this particular formula told us that Tesla was underperforming the benchmark index. So that might not be a great time to buy shares of Tesla. And of course, look what was happening to the stock. It was just kind of moving sideways there for a number of months. Okay, but then something interesting happens towards the end of September, and Tesla begins to outperform the S&P 500. And our indicator told us that on a very specific day. So there's no guessing whether Tesla is diverging from the RSI or whether the current RSI reading is overbought or oversold. There's no guesswork. We don't need to interpret a level on the RSI. All we need to do is look at this particular formula and determine whether Tesla is outperforming the benchmark index. And that's what it told us right here towards the end of September. What happens is the stock over the next few months goes up 1,868%. Okay. And once I reveal the formula to you and you guys go and check this out, you're going to find these opportunities all over the place. Now let's look at another one, Teradata, TDC. Okay, so October, November, December of 2019, you'll see the stock was just kind of moving flat. It was kind of fluctuating between around $18 a share up to, somewhere in the neighborhood of $23, $24 a share. But then again, something interesting happens in the beginning of 2020. The stock starts to outperform the S&P 500. Now, remember in 2019, the S&P 500 was on a tear. It was going up like through the roof, right? That was a great year for the stock market. So wouldn't it make sense to try to find opportunities that are outperforming a benchmark index that is already doing well? Well, that's what this particular relative strength formula found. Towards the end of January, it changed from underperforming to overperforming, as you see from the red to green histogram. And Teradata goes up 125% in just a couple of weeks. Pretty incredible. And what's amazing here is the timing, right? It gave us a little bit of advance warning before the stock really took off, but you can see this is not lagging information. Most indicators, including the RSI, lag, right? So by the time it gives us information, unless you're very lucky, it's probably going to be too late. Now, if we look at relative strength of a security as it relates to a benchmark index or industry or sector, that's not lagging information. It's going to tell us on that day when the stock begins to outperform. Okay. So I can tell you in my 22 years of experience, not many leading indicators out there that give us forward-looking information, but this is certainly one of them. This is actually an example of a relative strength trade that I recently placed in my hedge fund. So this is on Futu Holdings, ticker FUTU. And you'll see here that towards the end of, towards the beginning of the year, the stock started to outperform the S&P 500. Okay, and I had the indicator on my charts. I was monitoring this, and I saw the opportunity to jump into the stock. Now, at the time, it was trading somewhere between $40 and $50 a share. But then look what happens over the next month and a half. Futu is up 380%. You can see it hit it high there in early February of 204.25. So it went from trading between 40 and 50 when the relative strength indicator told us that it was beginning to outperform the S&P 500, and topped out at over $200 a share just a little less than a month and a half later. That's a 380% move. All right. And these are not flukes. These happen over and over again. Okay. So I'm going to give you the formula for this in just a second. So you can do this on your own. Now, I use a really simple 4-step process to trade my relative strength system. So I'm going to give that to you right now.